Warren Buffett just sold billions of dollars worth of US stocks. And when the world's greatest investor does this, you should pay attention, because this isn't random. Buffett has a long history of selling before major market crashes, and what he's doing right now could be a warning sign for what's coming next in the US stock market. In this video, I'll show you exactly what he sold, why he sold it, and what smart investors are doing right now to protect their money. Warren Buffett is famous for one simple rule: never bet against America. For decades, he built his empire by buying U.S. companies and holding them through wars, crashes, and recessions. He stayed calm in 2008. He stayed confident during COVID. He told everyday investors to keep buying when fear ruled the market. So when news broke that Buffett is quietly trimming U.S. stocks and piling up record amounts of cash, it sent shockwaves through Wall Street. This isn't a trader chasing headlines. This is the most patient investor in history changing posture. Buffett doesn't panic. He prepares. He doesn't react to noise. He studies structure. And when he moves, it's not emotional. It's mathematical. The real question isn't what he's selling. It's why now? Why shift away from American equities at a moment when markets are still near all-time highs? Why sit on hundreds of billions in cash when inflation eats purchasing power? Why step back just as optimism returns? Because Buffett isn't watching headlines. He's watching cycles, valuations, debt, interest rates, corporate margins, and the quiet signals most people ignore. His actions suggest something uncomfortable. The game may be changing, and those who assume the future will look like the past may be standing on the wrong side of history. When most people hear Buffett is selling, they imagine fear. But Buffett doesn't operate on emotion, he operates on math. What looks like retreat is often repositioning. Over the last year, Berkshire Hathaway has reduced exposure to several major U.S. stocks while building one of the largest cash piles in corporate history. That's not a crash call, it's a signal. Buffett buys when prices are irrationally low and sells when optimism becomes expensive. Right now, American markets are priced for perfection. Valuations assume steady growth, stable margins, and a smooth economic future. But reality rarely moves in straight lines. Corporate profits are under pressure, consumers are stretched, interest rates are no longer near zero, debt is no longer free. Buffett understands that returns aren't driven by stories, they're driven by entry price. Even great businesses can become poor investments when purchased at inflated levels. His moves suggest he sees more risk than reward in current U.S. equity pricing. Cash, in his world, is not weakness, it's optionality. It's the ability to act when others can't. It's dry powder for the next storm. While most investors chase momentum, Buffett is quietly preparing for opportunity. He's not running from America. He's waiting for a better version of it to go on sale. One of Buffett's core beliefs is simple: price matters. No matter how strong a company is, there is a point where future returns are mathematically limited by how much you paid. Today, many U.S. stocks are priced as if growth is guaranteed and risk has been eliminated. Market multiples are stretched. A small slowdown can cause large repricing. The higher the expectation, the more fragile the system becomes. When everyone assumes this time is different, the margin for error disappears. Buffett doesn't need a crash to justify caution. He only needs to see that future returns are likely to be lower than past ones. Rising interest rates change everything. When safe bonds offer real yield, stocks must compete harder for capital. Cheap money no longer props up every idea. In the past decade, investors were rewarded for buying almost anything. That era created habits that feel permanent. But Buffett knows markets move in regimes. What worked in a zero-rate world may fail in a normalized one. By reducing exposure at elevated prices, he's locking in gains made during extraordinary conditions. He's acknowledging that the tailwinds of the last cycle may become headwinds in the next. Valuation isn't exciting. It doesn't trend on social media, but it's the foundation of every long-term fortune Buffett has built. To most investors, holding large amounts of cash feels irresponsible. Inflation erodes it. Markets reward risk. Sitting on the sidelines feels like missing out. But Buffett views cash differently. He sees it as power. Cash is freedom. It allows action when others are trapped. During crises, when assets collapse and credit dries up, the only buyers left are those who prepared. Buffett has used this playbook before. In 2008, while panic froze markets, he wrote billion-dollar checks into companies desperate for capital. Those deals became legendary. He isn't hoarding money because he's afraid. He's stockpiling opportunity. When markets fall, prices don't politely decline. They gap. Great businesses become available at irrational discounts. But only investors with liquidity can move. Most portfolios are fully invested. When stress hits, they must sell to survive. Buffett structures himself to be the buyer when that happens. This isn't about timing tops, it's about asymmetry. When prices are high, upside is limited. When prices collapse, upside is enormous. Cash lets him exploit that imbalance. By building reserves now, Buffett is positioning for a future environment where patience becomes profitable again. He's waiting for volatility to return as an ally. In his world, cash isn't idle. It's a loaded spring. Another quiet factor shaping Buffett's behavior is the scale of American debt. The U.S. economy has grown, but its obligations have grown faster. Government debt is at historic levels. Corporate borrowing surged during the era of near-zero interest rates. Consumers are carrying record balances on credit cards and auto loans. Debt isn't dangerous when money is cheap and growth is strong. It becomes dangerous when rates rise and growth slows. Refinancing becomes harder. Margins shrink. Defaults increase. What once looked manageable starts to feel heavy. Buffett understands that leverage amplifies cycles. In good times, it boosts returns. In bad times, it accelerates damage. Entire sectors that thrived on easy money now face a different environment. Real estate, speculative tech, and heavily indebted firms must adapt to higher capital costs. Markets often price the present, not the future, but Buffett invests across decades. He asks what today's balance sheets look like under stress. He asks what happens when optimism meets math. Reducing exposure in a highly leveraged environment isn't pessimism, it's discipline. He's acknowledging that the financial structure beneath the market is more fragile than it appears. Debt doesn't cause crashes by itself, it makes them sharper. Buffett is stepping back from a system where small shocks could create large ripples. For over a decade, markets lived in a world of artificial comfort. Interest rates near zero made risk cheap. Central banks acted as safety nets. Every dip was met with stimulus. Investors learned that patience was unnecessary because policy would intervene. That environment shaped an entire generation of market behavior. Growth at any price became normal. Profitability became optional. Speculation felt rational. The assumption was simple: liquidity would always be there. But regimes change. Inflation forced central banks to reverse course. Money is no longer free. Capital now has a cost. Businesses must justify themselves again. The market is being asked to stand without constant support. Buffett built his philosophy in a world where capital was scarce and discipline mattered. He thrives in environments where fundamentals dominate headlines. The return of constraints is not a threat to him, it's familiar terrain. By reducing exposure now, he's acknowledging that the rules are shifting. Strategies that thrived under abundance may struggle under scarcity. Companies built on leverage and optimism must now survive under scrutiny. This transition doesn't happen overnight. It unfolds unevenly. But Buffett isn't waiting for consensus. He's adjusting to the reality that the tailwind that lifted everything is fading. The market is relearning gravity. Buffett is acting like it already has. Late-stage markets share a familiar emotional pattern. Confidence replaces caution. Risk feels normal. Stories outweigh numbers. People stop asking what could go wrong and start assuming progress is inevitable. Buffett has seen this movie many times. The late 1960s, the dot-com era, the housing boom. Each cycle ends the same way. with the belief that the future has been solved. That belief is always the most expensive. He doesn't predict crashes, he observes behavior. When investors justify any price, when leverage becomes casual, when warnings feel outdated, risk is rising, even if prices are still climbing. Markets don't collapse because everyone is afraid. They collapse because too many people are comfortable. That comfort reduces margins of safety. It compresses time. It turns surprises into shocks. By trimming exposure, Buffett is stepping away from collective overconfidence. He's refusing to be anchored to recent success. He's reminding himself that cycles end not with panic, but with certainty. This is the discipline most investors lack. They adapt emotionally to whatever just worked. Buffett adapts mathematically to what must eventually fail. He isn't calling an end. He's acknowledging that optimism has outrun resilience. And in markets, resilience matters far more than excitement. Buffett's greatest wins didn't come during calm markets. They came during chaos. He built legends by acting when others were frozen. In 1974, in 2001, in 2008, he deployed capital when fear made prices irrational. Those moments don't appear in stable environments. They are created by stress, by tightening credit, by broken confidence, by forced selling. Buffett is preparing for that landscape. When markets rise smoothly, there is no urgency to act. When markets break, urgency becomes universal. Companies that were once untouchable seek lifelines. Governments open doors. Terms become extraordinary. Buffett doesn't know exactly when the next dislocation will arrive. He doesn't need to. He only needs to know that cycles guarantee one will. Every era of excess produces its own reckoning. By stepping back now, he preserves flexibility. He avoids being emotionally tied to prices that assume perfection. He remains able to say yes when others can only say, survive. This is the difference between reacting and designing. Most investors are forced into decisions by markets. Buffett structures himself to decide. He is not forecasting disaster. He is preparing for inevitability. Stress is not a question of if, it's a question of timing. And timing favors those who arrive liquid. Many investors misinterpret Buffett's moves because they think in headlines, not horizons. They see selling and assume fear. They see cash and assume indecision. But Buffett's timeline is measured in decades. Retail investors often anchor to recent performance. If markets rose last year, they expect them to rise again. If a stock doubled, they believe it can double again. This creates a rear-view mirror mindset. Buffett operates forward. He asks what today's price implies about tomorrow's reality. When those implications become unrealistic, he steps away, regardless of momentum. He also understands that being early feels wrong. Holding cash while others profit creates discomfort. But comfort is not the goal. Survival and optionality are. Most investors are taught to stay fully invested. Buffett knows that full investment is a vulnerability. It removes strategic choice. It ties outcome to timing you don't control. He doesn't care about looking right today. He cares about being positioned for what others can't imagine yet. That's why his actions confuse people. They expect reaction to events. He acts before events exist. Buffett isn't predicting a specific crash. He's building resilience against surprise. And in markets, surprise is the only constant. It's tempting to frame Buffett's shift as pessimism about the United States. That misses the point. Buffett still believes in American enterprise. He still owns enormous stakes in U.S. companies. He still praises the long-term strength of the economy. What he's adjusting is timing, not faith. Belief in a system doesn't require blind participation at any price. True confidence allows patience. It allows waiting for rational terms. It allows stepping back when enthusiasm outruns value. Buffett isn't leaving America. He's refusing to overpay for it. Markets move faster than economies. Prices overshoot reality in both directions. Buffett's strategy is to align with reality, not with excitement. He knows America will endure. He also knows markets will misprice that endurance repeatedly. Those mispricings are where fortunes are made. By reducing exposure now, he preserves the ability to buy later, when others are selling out of necessity, not choice. That's not disloyalty. That's discipline. He's preparing to invest in America again under conditions that reward courage rather than complacency. Optimism doesn't require constant action. Sometimes it requires waiting for the right moment to believe with capital. Buffett's actions carry a message that's easy to ignore and expensive to forget. Cycles exist, regardless of narrative. Markets do not move in straight lines. They breathe, they expand, they contract. When expansion feels permanent, contraction becomes invisible. That's when risk is highest. By shifting now, Buffett is reminding us that time matters, entry matters, structure matters. What worked yesterday may fail tomorrow. He isn't calling an end. He's preparing for change. In every cycle, there is a moment when caution feels unnecessary. That moment is usually the most dangerous, not because collapse is immediate, but because resilience disappears. Buffett is restoring resilience to his portfolio. He's teaching, without speaking, that the purpose of investing is not to chase every gain. It's to survive every storm and still have the ability to act. Markets reward patience only after they punish impatience. He's not predicting what will happen next. He's ensuring that whatever happens, he's ready. That's the difference between reacting to history and positioning for it. And that difference is where fortunes are decided. Warren Buffett isn't giving a warning. He's offering a lesson. Not in fear, but in preparation. You don't need to copy his trades. You don't need billions in cash. What you need is his mindset. Ask yourself what your portfolio assumes about the future. Does it depend on everything going right? On rates staying low? On growth staying smooth? Or does it allow for surprise? Markets don't fail because people are pessimistic. They fail because too many are certain. Buffett is stepping away from certainty. He's creating space for opportunity. You don't have to exit everything. But you can build flexibility. You can reduce fragility. You can stop assuming that yesterday's environment is permanent. Study cycles. Respect valuation. Understand that the best opportunities are born from stress, not comfort. Buffett isn't running. He's waiting. The question is simple. When the next opportunity appears, will you be forced to react or free to act? That decision begins long before the storm. It begins now.